This is alarming. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we have a shocking development as the latest data now confirms that the U.S. economy is on the verge of a collapse. Plus, we have a sponsor for today's show, a sustainable fishing company that has some amazing technology and amazing story as well. But what's even more amazing is the chart setup. My friends, this is perhaps the best chart setup that we've had featured on this show with any of our sponsors. Stay tuned for more information or check out the description and the pinned comment below for more information. Let's over to Zero Hedge, where we picked today's story up with a headline: initial claims at the highest since October 2021 as Texas jobless count soars. Now, why do initial claims matter so much? And it does because when you start looking at the economy, as people lose their jobs, this isn't like during the pandemic where they get 100% of their pay or even more than 100% of their pay. They have to take less money through the unemployment system. And when you're at a point in an economic cycle where you have a massive amount of debt, and we have record high debt levels right now, and you have historically, relative to the norm, high interest rates, which we do, that means the cost to service this debt is high as well. So as someone loses their job, well, then what they're forced to do is cut their discretionary spending in a big way, and that then flows back into the broad economy and kind of snowballs. As more people lose their jobs, then next thing you know, the economy slows more and more and more. And so the challenge then, as we start to look at Texas, is what's going on with Texas and why all of a sudden this recent surge in claims matters. After the prior week's surprise surge in initial jobless claims to the highest since October 2021, last week was expected to see a modest slowdown from 261,000 to 245,000. However, things remain troublesome, with 262,000 Americans filing for unemployment for the first time last week, and we had an upwardly revised 262,000 from the week before. Now, what's unusual here is as we head into the summer season, we've seen companies staffing up here. We hear companies saying they would like to hire more, but there's one problem in the economy that everyone thinks is going to turn around as the services sector surges into the summer, and that's the manufacturing sector, and we're not seeing that at all. As we head over to the Texas manufacturing sector to try to figure out why are the unemployment claims in Texas surging against the rest of the country, well, we see in their manufacturing report from the Dallas Fed that the sector continues to face declining orders. Now, let's look at this. This goes back to May 30th, and their next report's coming here pretty soon. But look at this. Perceptions of broader business conditions continued to worsen in May. The general business activity index dropped 6 points to minus 29.1, the lowest reading in 3 years. But then you come down to this next paragraph, and what do you see? Well, labor market measures suggest continued employment growth, but flat hours. And so this is kind of unusual. You would normally think that, well, as things slow down, employers would shed workers. But this is a case where post-pandemic, they've trained a lot of people, and they're now poised to handle a change in growth. There's no landing or the soft landing the Fed keeps telling us is coming. But employers, they've been holding on. Now, let's see the change here, because remember, this report came out May 30th, so it's kind of a middle of month survey. Now all of a sudden, about 4 weeks later, everything starts to change. And here, even going back and looking at the report in the comments, we're seeing a massive slowdown in business activity. Business is slowing down, that is for certain. And here you can see we have a large seasonal job openings that will keep people working through Labor Day. But what after that? General business activity is definitely slower. There's nothing encouraging on the horizon. So you start to look at Texas and say, why are we seeing Texas slow down ahead of all of these other states? Does this mean that other states are going to soon fall? Well, the answer to the second part is yes, but let's take a look at what's going on in Texas in particular. Here we can see the general business activity. This is the diffusion index for Texas against crude oil prices, and the Texas economy is highly sensitive to the price of crude. So when you see crude oil rising, here you see in the red line, what you expect is business activity, what we can note between 2010 and 2014 steadily start to rise. Now, there are some anomalies here. You can go back to the global financial crisis. You see crude oil prices rising as business activity in Texas started to fall, indicating that the economy was really weaker here. It wasn't a function of higher oil prices that was really helping. They were too high relative to the economy. But if you look past that, you see a general indicator, they kind of move together, that as crude oil prices rise, business activity in Texas goes with it. So this recent slowdown in crude oil prices, as we've talked about on the show, which has a major impact, is trying to tell us that global demand, the global economy is slowing, is now coming right back to Texas. In less than about 4 weeks from when that report, those surveys were taken, now all of a sudden we're seeing people losing their jobs. And as we look deeper, we see in the new orders this out of Texas, what we can look is when we look at national, we're going to overlay now the 4-week moving average of initial claims, which just for point of reference is just shy of 250,000, which many of you remember is a key inflection point, which we'll talk about here in a little bit. But normally you see new orders decline, and you see nationally, all of a sudden you start to see this 4-week moving average initial claims go up. You can see it back right now. You can see the 4-week moving average claims flattened out and started to head higher as those new orders ended up contracting. And that contraction, remember, is anytime we see these diffusion indices below that horizontal black line. But there was one anomaly, and that was 2015 through 2016. You notice that initial claims actually continued to head down because the global economy indeed rebounded. So the fact is, we're seeing claims head higher, not lower, which is telling us that perhaps the U.S. economy is indeed on the verge of collapse. And here we can look back at the recent report, 262,000 back-to-back weekly claims. We note the 4-week moving average just shy of that 250,000 number that I think really matters. But what we're also not seeing is a big drop-off in continuing claims. And these are people that are on unemployment for 1 week or more. It's been hovering right around 1.8 million, just shy of that today at 1.775. And the key thing here when we talk about continuing claims is you can see an initial rise in claims, and if that is offset by a decrease in continuing claims, where we're seeing workers that are going back to work after being on unemployment, then what we'll see is initial claims start to come down. The problem now is we're not really seeing continuing claims fall at all. So as we compare the two, we can note that there are periods where the 4-week moving average initial claims shown in blue rises, and the continuing claims number, you can see parts where it's flattened out and then it slowly starts to creep higher. You can see that going into the global financial crisis, and you see it now as kind of flatlining a little bit, but initial claims are pushing higher. And all that will take a matter of tipping the economy over is the fact that if we see a continued increase in initial claims while people are on unemployment or unable to find work. And as I mentioned before, and we've talked about this in past shows, I think that 250,000 number is critical. Here we can see on this chart the 4-week moving average initial claims. Remember, it's about 246,000, so right below that 250,000 threshold. And you'll notice I have this red line. This is 250,000 weekly claims on average over the last 4 weeks. And you kind of know when you have periods, and we don't have a lot of reference points, but we have a period where you see relatively low claims back into the 60s. When it broke through that 250,000, it surged higher. That happened again just going into the mid 70s. It kind of broke that number and headed higher, and now we're seeing it on the cusp of that again. And again, this all just comes back to kind of where we started the story out, that as enough people start losing their job and their consumption gets reduced, that eventually it flows broadly into the rest of the economy. So it suggests that what's kind of going on here in Texas perhaps is a leading indicator in terms of the factory sector. So what we're going to look for now in the coming weeks to see if other states that have big manufacturing bases start to lay off, and the answer is we're probably likely to see that. But in the data today, we're getting some headlines that say perhaps that retail sales numbers are actually showing a robust economy, but hold fast, it's not as good as the headline suggests. U.S. retail sales unexpectedly rise in sign of consumer resilience. This from Bloomberg, as purchases climbed 0.3% in May, beating all but one estimate, but yet the figures show moderating consumer demand. So which is it? Are we unexpectedly rising, or are we moderating demand a little bit? Let's dig deeper in the report and see. While the figures came in stronger than expected, they still show moderating consumer demand for the past year as Americans have kept spending against a backdrop of elevated prices and higher interest rates, supported by a still vibrant job market, which may not last for longer, and we'll talk about that, and pent-up savings. Now, what's interesting is I've asked many of you about this in the comments to comment about this pent-up savings, and many of you are saying, look, Steve, I have no idea where all this pent-up savings is. I don't have it. I don't know anyone that has it, but yet the experts keep saying that Americans have tons of savings and it's all going in to support retail sales here. But maybe as we dig deeper, it's not quite as good as it seems. Looking at the breakdown, there's a couple of points that are worth noting here. Is motor vehicle and parts dealers are up. Now, could this be part of the fact that people are having to go back to the office a few days a week? This I'm not sure about. If you have any inclination on that, please let me know in the comments. We'll see building material and garden. So as people head into the summer and have more time available and sunlight, it looks like they're spending some money on the yard. But look at this, gas stations are down minus 2.6%. You would think that going into the summer as people are having holiday season, Memorial Day, that this would be up. Potentially if people are headed back to the workforce, but this tells us demand is down. That's why you see crude oil prices lower. And miscellaneous store retailers, they're down as well, minus 1%. So again, we're seeing some indications that we don't know what's driving the auto story. We don't know what's driving the home and garden story, but we do see in the gasoline and small store retailers that yes, there is a marked slowdown here, which would make sense. Again, as more people are off work because they lose their job, they have to dedicate what income they do have to higher energy prices, higher food prices, higher rent prices, and paying on their debt, leaving a much less money for discretionary spending. But will this retail sales story last much longer? Well, probably not. As we take a look at advanced retail sales, this is in blue on a year-over-year rate of change. We're going to overlay the 4-week moving average of initial claims. Now, what I want you to see here is kind of where you get a peak in retail sales. You kind of get a trial in that 4-week moving average initial claims. But notice as claims rise, you see the red line head up, that you see the retail sales, it's still on a year-over-year rate change is growing, it's just slowing. And you see that kind of here again. We see kind of retail sales get close to a peak, and we see the 4-week moving average starting to climb, and notably retail sales hold on and then fall off a cliff. And here we are again, we see the bottom in initial claims is marked by a slowdown in retail sales, which actually would tell us that this pent-up savings, this mythical pent-up savings, really doesn't exist to the extent that the experts suggest it does, because if that was the case, we'd see retail sales probably much higher. But what it's telling us is that too is about to head off a cliff in the months to come. The control group sales suggest household spending will remain positive, but will decelerate in the second quarter because the retail sales data aren't adjusted for changing prices or meaning inflation and only include a one service sector category. It can be difficult to draw concrete conclusions. But more complete inflation-adjusted data on May outlays, including services, are due later this month. But we can commit a little bit of chart crime here because this isn't exactly how it should be done, but it's the closest thing we have. We can take the year-over-year rate of change in retail sales, subtract off the year-over-year rate of change in consumer price index, and it gives us an idea where things are at. And what we can do is we can go back to the dot-com bubble. We can see that against inflation, retail sales did go negative. We can see during the global financial crisis, they went steeply negative. And now it's happening again, because what's interesting here is that headline number is frozen around 0, suggesting that retailers are doing the same volume they did a year ago. The problem is for retailers is their prices have gone up. Inflation has gone up. Their hiring costs, their labor costs, everything is higher. What they need is retail sales to be going up, not down against inflation. And then we turn over to U.S. factory output is nearly stalling as the sector struggles for traction. And this again should not come as a surprise, because when you start to see states like Texas start to slow down and lay people off, and we know they have a heavy manufacturing base there, but what we should start to see is this backflow across into the national numbers. And we're seeing that now as production edged up 0.1% in May, but fell 0.3% from a year ago, now entering contraction as manufacturing output advanced 0.1% from a month earlier, but was still 0.3% lower than a year earlier. Total industrial production, which includes mining and utilities, fell 0.2% in April. So what are we seeing so far, my friends, is this is validating what those regional Fed surveys have been telling us, is there is a marked slowdown in the manufacturing sector. It's validating what we're hearing in these PMI data, not just from the US, but all around the world, is we're seeing a global manufacturing slowdown. Everyone's betting the services sector pulls it out. I don't think that happens. What do you think? Weigh in the comments below. The details painted a mixed picture as factory production increased for motor vehicles, which we've kind of already noted in the retail sales data, aerospace equipment and appliances, output of consumer goods, including clothing and home electronics, and business equipment, of all things, hedged lower. And the nation's producers faced a number of challenges, including softer demand for merchandise as households direct more of their income towards services and experiences. Now, the question is, as we head into the summer months, how much of that demand for services and experiences will wane as people are now becoming worried about losing their job? Well, only time will tell. But stricter lending standards, as we talked about many times on the show, and higher rates risk forcing some companies to tighten their belts on capital investment because they just can't get a loan or the loan's too expensive, while overseas customers are contending with muted economic growth. And as we look at the charts, one of the things people comment about frequently is, hey, why is it that the economy seems to be slowing, but the stock market keeps going up? Now, you have to remember, just because investors want to buy stocks or speculators want to buy stocks does not mean the economy goes up. In fact, it's not unusual to see, in fact, investors believe that the economy is actually going to turn around. They're trying to buy the market, thinking the market's going to lead the economy up, but it doesn't always play out that way, particularly right ahead of a recession. Here we can see the industrial production total index on a year-over-year rate of change against the Wilshire 5000 or total U.S. stock market, also on a year-over-year rate of change. And what we can see is you can see these rallies kind of on, again, this is shown on a year-over-year rate of change. So you see a rally on the equity market, and then immediately gets reversed as industrial production doesn't rebound. You see that going into the dot-com bubble. You see that kind of going into the global financial crisis. And now you see it now as, again, investors are betting big on that no landing or soft landing, or perhaps it even a Fed pause here will actually make a difference. I don't think it does at all. I think everyone chasing the market higher will eventually find out the economy is indeed slowing down, and is slowing down much faster than many want to believe. As we look at industrial production, again, we come back to that 4-week moving average initial claims, right where we started the show, saying that, look, as industrial production peaks and starts to slow down, notably, it is matched with the 4-week moving average of initial claims rising. We see that in the early 70s. We see that in the late 70s. We see that in the late 80s. We see that in 2000s. Again, every time you see the initial claims rising, you see industrial production coming down. We're seeing that now, effectively validating everything we know, that the U.S. economy is perhaps right on the verge of a collapse. We could be maybe weeks or even months away from this happening. But now what I'd like to do is introduce you to our sponsor for today's show, Nocera, and they are a innovative land-based RAS combined with its expertise in engineering are the answers to a rapidly increasing global demand for high-quality seafood. You can find them trading on the NASDAQ, NCRA, and of course we have all this information for you in the pinned comment and in the description below. Let's take a look at what Nocera does and what makes them so special, and I'm going to show you a chart setup that is, again, unlike any that we've shown on this show. We design, build, and procure the equipment needed to build and operate land-based fish farms. Our primarily manufactured product is recirculating aquaculture systems, or RAS. We provide EPC, engineering, procurement, construction solutions to the aquaculture industry. They focus on land-based RAS systems that are highly efficient with extremely low environmental impact, highly efficient, provide a cleaner and safer environment for fish farming, and their versatile design limits environmental impact. Their goals are to be energy efficient, protect the ecology, and have 80 times, if you can imagine, 80 times the production than a traditional fish farm. Their independence from weather and variable environmental conditions makes a big difference in what they can produce in terms of fishing. Their reduction in wastewater, increased biosecurity, they prevent disease outbreaks, they maximize production, and they reduce land needs, and this is their flexibility and independent. When they come out and select a site, this is what they do. And they currently have 7 sites approved for Taiwan, and working closely with solar EPC companies like JV Energy Technology, on the future of solar sharing fish farms. Now in 2022, they're still working on this. They're planning on expanding at some point into the Americas, and they've divested from all their operations in China. They had a whole bunch of them. Now they're moving into Taiwan and soon into the Americas. But check out this chart. So we've got the technicals, we've got the volume profile turned on. We're going to look at a 2-year chart here, and what do you see? You see a lot of shares traded right below where it's trading today. But what's key is when you look at this chart, what do you want to see in a building rally? Well, you want to see prices cross a moving average, and we'll zoom in on this a moment. They crossed the 21-day, 50-day, 100-day, 200-day, and then what you want to see them come back and confirm that, pull back a little bit, or even go sideways, confirm the moving average as support, and then rally off of there. We know that momentum is still positive. Slow down a little bit. We see price trading sideways. As we zoom into the 6-month chart, we can see the MACD kind of trending down. We get momentum slowing down a little bit. Validating that is the RSI, but you can know here now you can see this 50-day moving average curving up. It's going to intersect with the price chart pretty soon. The 200-day moving average is flattening out. Again, both of these are acting as support, not to mention this big pile of volume traded down here. As long as these people are holders, then what that means is you're going to find support somewhere right in here, and then the next move higher in the stock to come. As we zoom in, you can see right now buyers and sellers we're looking at the last 30 days are kind of evenly matched here. If the buyers can overcome the sellers, we could see a move before confirming their moving average, but that is yet to be seen. We'll know that sooner than later here. But as always, when any company featured on our show, you're under no obligation to buy the stock. Please do your own research. The symbol is NCRA. They're on the NASDAQ. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.